The dollar to silver ratio is a measure used to compare the value of the US dollar to the price of silver. Historically, this ratio played a crucial role in monetary systems when silver and gold were used as the foundation for currencies. It provides insights into the historical and modern relationship between currency and precious metals. Let's break it down. The dollar to silver ratio essentially shows how many dollars it takes to buy 1 ounce of silver. For example, if silver is priced at $25 per ounce, the dollar to silver ratio is 25 to 1. This changes daily based on the global price of silver, which is determined by supply, demand, and market speculation. Historically, the dollar to silver ratio was tied to the bimetallic standard, where both gold and silver were used as legal tender in the US. In the late 18th and early 19th centuries, 1 ounce of silver was legally set to be worth about $1.29, a fixed ratio defined by the government. This ratio ensured that silver coins circulated alongside gold coins in the economy. However, as the global economy evolved, the US and other countries moved away from using silver and gold to back their currencies. By the 1970s, the US dollar was no longer tied to precious metals, and its value became based on fiat money, meaning it is backed by trust in the government rather than by physical assets. Since then, the dollar to silver ratio has been determined by the free market, and it fluctuates significantly. Let's look at a modern example. Suppose the price of silver is $20 per ounce, and you have $100. With this ratio, you could buy 5 ounces of silver. If the price of silver rises to $50 per ounce, your $100 would now only buy 2 ounces. This shows how changes in silver prices directly affect the ratio and the purchasing power of the dollar in terms of silver. The dollar to silver ratio is also important for investors and economists as it reflects inflation, currency strength, and market sentiment. When inflation rises, the value of the dollar weakens, and people often turn to silver and gold as safe haven assets. This increased demand can drive up the price of silver, causing the dollar to silver ratio to decrease. For instance, during economic crises, silver prices often spike as investors seek to protect their wealth. However, it's important to note that the ratio doesn't tell the whole story. Factors like industrial demand for silver, mining production, and technological uses, like in electronics and solar panels, also influence silver prices, making the dollar to silver ratio more complex than just a simple comparison.